Thank you, Matt, and good morning, ladies and gentlemen. As Matt rightly pointed out, my name is Philip Wooler. I'm the Area Director for STR for Middle East and Africa. And I've got 10 minutes just to give you a quick, or to share some insights of the global and regional hotel markets. We're going to start with the global picture, and then we'll have a closer look at Africa and some of the key cities, and then we'll have a quick look at profitability before we finish off. Every time I fly over Africa, I'm reminded about how huge it is as a continent. Absolutely colossal, and probably the final frontier of real serious development. And just to add some context, the US, which takes that kind of central strip, we have 63,000 hotels in the US. In Western Europe, which can certainly fit into the top half of Africa, 61,000 hotels. In China, 16,000 hotels. But in the whole of Africa, as it stands at the moment, around about 5,500 hotels. It's a remarkable opportunity, and you just wonder where it may be in 10, 20, or even 50 years. For those of you who are not familiar with STR, we collect hotel data, mainly the room side, so we're looking at occupancy, average room rate, and RevPAR. We also look at supply and demand trends. We also look at food and beverage, profitability, and pipeline. And the business is growing. We're currently 54,000 hotels globally, 110 countries, and it represents 7.5 million rooms. All this bragging, we're not quite in Togo, something we're working on, but still significant progress. In terms of the coverage, main coverage is in the US, 34,000 hotels, 4 million rooms. Western Europe, 9,500, 12 million, 1.2 million rooms. And then Middle East and Africa, smaller emerging markets, 760 to 800 hotels in both. And in Africa, 137,000 rooms. And just having a look at supply demand. Supply demand, one of the key indicators of where any market is moving. This is the year-on-year to April 2016. And generally, we've had very low supply across most of the regions in the last 4 or 5 years since the economic collapse. The US has only been averaging around about 0.8%, Europe pretty much the same, and that has promoted or given opportunity to better and improved performances across those two regions. The Middle East, significant changes. At the moment, supply year-on-year 5% up. Demand is trailing, which is why there are issues in the Middle East in terms of average room rates and occupancies. In Africa and South America, we have seen drop in demand. There is a small increase in supply in both, 0.9%, but Africa currently demand is down 3.5%. And what does that mean to RevPAR? Just really a quick glimpse. I mentioned North America and Europe, very, very small supply, which has given opportunity for an increase in RevPAR. Year on year, 3.5% in North America, 4.3% in Europe. Middle East and North Africa is a different picture. Huge new supply. We obviously know about some of the challenges, the oil price, but the Middle East in terms of RevPAR has dropped 11.7%. North Africa, a lot of Egyptian data. 2 steps forward, 10 steps back, a very challenging country, but a lot of the data shown there will be significant for the Egyptian market. And in Southern Africa, we'll have a look at some of the key cities, but South Africa has, due to currency, weakening currency, has given opportunity for RevPAR growth, 8.9%. When we look at Africa, occupancy and average room rate and RevPAR, this is percentage change from 2010. So we can see how occupancy moved up from the financial collapse of 2008-9, started to push up across the continent. Occupancy, average room rate, fairly static through that period, but RevPAR growth. 2012, we had some issues in certain areas of Africa. Egyptian data will influence that to some extent. But from 2013, we have seen significant RevPAR growth for the last 46 months. It's interesting to see in Africa, regardless of some of the issues and the challenges, generally average room rates do not drop that much. In fact, sometimes you see occupancy drops and you see average room rates increase, so it's quite an unusual trend. In terms of RevPAR percentage change, this again is up to April 2016, year to date. The green is positive RevPAR growth and the red is negative. And it seems that the countries with greater diversification are performing better than the countries which are more reliant on perhaps one commodity. Lagos, small growth, but there has been some quite significant changes. Oil price, supply, geopolitical situation, but it seems to be hanging on to the RevPAR position at the moment. Gaborone, slumping commodity, particularly diamonds, so there has been some issues there. Ghana, economic concerns. But at the bottom of the country, South Africa, again, benefiting from currency, some significant growth in both Cape Town and Johannesburg. And if we look at Africa key cities, these are the absolute numbers, so occupancy and average daily rate, again through to April 2016. The blue is occupancy and the red is average room rate. And again, you have to take into consideration currency fluctuations, but it is really the only way you can get some understanding or some comparables across the continent. So the most expensive city on the African continent is Lagos, currently running at $208. But I do remember 2 or 3 years ago, Lagos was more in the sort of $350 to $400. So supply, perhaps oil, geopolitical situation has dropped the average room rate. And the occupancy, 43%, so a little bit weaker than normal. The cheapest country at the moment, or cheapest city to buy hotel rooms across the continent, Johannesburg. Again, have to take currency fluctuations into consideration. If you look at the local currency average room rate increase, it's 6%. But if you convert to US dollars, it's minus 20.5%. So seriously benefiting from the currency weakening. Cape Town, respectable 78%, the strongest occupancy across the continent. Again, local average room rate increases 12.6%. USD would be minus 15.6%. But generally, occupancies across the continent, 50, 55-ish. And just really to bring some perspective to some of the global markets. Dubai is the strongest. It's now approaching the summer season, so we will see some drops. But at this point, April, Dubai had the strongest average room rate globally, around about $220. But you can see Accra and Lagos, so pretty strong average room rates, Accra and Lagos. New York, London, powerhouse cities, sitting behind, around about $170 to $180. Algiers and Marrakesh, around about the $140, $160. and at the bottom, Nairobi at 140, still respectable. So pretty strong average room rates in some of the key cities in Africa. And trying to bring some understanding to the gains and losses, where have they come from? Marrakesh, a lot of new supply, particularly in luxury, has driven down the rates, and RevPAR has dropped 28.3%. Accra, demand drops, the blue is occupancy, average room rate has increased, but RevPAR declines of 17.1%. In the middle, Dar es Salaam, Nairobi, occupancy drops, average room rate gains, unusual. And at the top end, again, we've got South Africa. Strong growth in occupancy and average room rate based on local currency. RevPAR percentage change, some of the key cities, Lusaka, we've got an outlier there. The Kwacha, many of you will know, weakened by 42% against the US dollar in 2015. And in 2016, it's bounced back, so plus 20%. So in local currency, a significant increase in RevPAR. Other cities in positive territory, Maputo, Cape Town, Joburg, Windhoek. And at the other end, a few of the challenging areas and cities, Harare, Gaborone, Accra, Agadir, and Marrakesh. And finally, just a very quick look at total revenue per available room and gross operating profit per available room. Again, we put these into two buckets. It's just very, very directional data. Northern Africa, we have seen some increases, 8.3% on TRevPAR and 6.1% gross operating profit per available room. Egyptian data, low base, has quite a bit of impact on Northern Africa. And in Southern Africa, some of the key cities are down, some up, but as mentioned before, South Africa is very much part of that data, and some fairly significant increases in gross operating profit per available room. That is a very quick snapshot. The presentation will be available on the Bench Events website, AHIF website, after this conference. And if there are any burning questions, I'm happy to take those. And then I will hand over to David Harper from...
Well, thank you, Philip.
Thank you.
We do have time for one question here. Has anyone got a burning question? Because if not, I've got the question for Philip, which is, if I gave you $1 billion now, Philip, where would you invest it in Africa?
That is such a tough one. I would be looking for diversification in the economy. Obviously, you've got South Africa, which has recovered from the World Cup. It took a long, long time. South Africa is an option. Botswana is an option. Togo is also an option. So that's as much as I can offer.
So he gets out alive. Well done,
Thank
Philip.
you.